If you want something early enough to where the fundamentals and the hype value pushes it to a 20 times valuation from where you bought it at. That's what you really, really want. Those are the big wins. Now, a part of Palantir's price is just hype. Palantir's real price is like $20, $30. But the hype and the potential and the fast rate they're growing, the value is higher. Now, remember what a stock is. A stock is a piece of a company. Now, if you add up all the stocks, the company has a value. Now, companies, if I sold my company, if I had any company that I have right now, and I've sold companies before, 3 companies before in the past. Now, if I sold a company, what we sit under the table, they look at the revenue, they look at the profit, they come up with a valuation based on how many months of revenue minus all the debt and stuff that you have, and it's a price on that. And you can negotiate that. Well, it's 36 months of revenue we're going to pay you for this. Well, I want 40 months. Well, we can do 38. See, it's kind of, but it's in a tight range. And it's based on revenue because they're going to take out a loan to buy that company in more cases than not. And they have to have the profit that comes off the company to be more than the loan payment. So if the loan is at 3, 4, 5%, your company got to be producing 20% of what it's worth. So if I put $1 million into this company, I needed to produce, at least, 20% return on that million. So I need to profit at least $200,000 a year, because if I take out $1 million loan and it's at 5%, I can make the 15% difference. That you couldn't buy a company that didn't make any money for $1 million, because you'd end up in a high risk position because you got to pay for the loan and you ain't making no money. That's why small companies are evaluated. But now big companies, most of the stock market is valued like that. But the companies with hype like Palantir can be valued on future potential. And it technically could be overvalued. And we know this because of the PE ratio, price to earnings ratio. And that tells you, and that's in the stock metrics, when you look up a stock, it says P&E ratio. It tells you how much investors are paying for each dollar of that company's profit. So it's calculated simple. It's calculated by dividing the stock price by the company's earnings per share. It's called an EPS. If a stock is $100, it earns $5 per share. That means that the P&E ratio is 20, right? Because if you take that 100, you divide it by 5, you get 20. 15 to 20 is good. 15 is really what we're going to look for. 15 to 20 for an average stock is good. Now, tech companies, sometimes they're over 30, which is good because tech companies are valued a little bit different because they don't have the same, they scale differently. They grow a lot more rapidly. A lot of times tech companies don't have to get new employees, especially software companies, because software is easily copyable. So you don't have to have new employees. A car manufacturer has to have more employees the more they scale out. That's the difference. So a company, like we said, has true value: revenue, profit, debt, cash flow. So an average company is 15 to 20 P&E. That means if you take all the value of you take the stock, you divide it by how much that stock earns per share. You take out all the revenue that company makes, you divide it by the outstanding shares, you get a number. And you get what the stock value is. You divide the stock price by what the earnings per share is, which is also on the stock metrics. You get a P&E ratio. And that P&E ratio should be around 15 to 20 for an average run-of-the-mill stock. Now, a tech company could have 30, 40, 50, and that's still okay. Once you get over 100, it's ridiculous. It starts to get scary. Right now, Palantir's is 560. So that tells you something right there. Tesla, an average company may be 15, 16. So that means that people are paying that much for a company that if you bought it in the open market, you wouldn't even make any money on that company. If you bought all the outstanding shares, you'd actually be in debt, severely in debt. But the price is high because of potential. So that's where a lot of the naysayers are saying the risk point is. It could be failed because of that.